The recent IRS layoffs and your money. Do you really need to do your taxes this year? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. So, the IRS, our government's internal revenue service, has been the talk of town this week, and not just because tax day on April 15th is approaching fast, but mostly because some headlines suggest that this tax day may not be like the others before it. According to The Independent, IRS braces for $500 billion drop in revenue as taxpayers skip filings in wake of DOGE cuts at agency. While not everyone is quite prepared to risk skipping their filings altogether, the Wall Street Journal reports that some tax professionals said their clients are asking about taking more aggressive positions on their returns in light of the IRS compliance layoffs. And a bit to my surprise, it seems that some of you are also pondering whether you really need to do your taxes this year. So, with that in mind, and as we usually do here at Diamond NestEgg, let's talk about what's actually happening with the IRS and this year's April 15th tax deadline. Here are the three topics that we'll be covering in today's video. 1. What do the recently announced IRS cuts mean for you and your money? 2. Which treasuries rose the most and which ones fell this past week? And 3. What's on the upcoming Treasury auction schedule? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What do the recently announced IRS cuts mean for you and your money? The IRS published this nice table on its website, showing that this year's tax season, so far, has been more or less comparable to the same period last year, as per mid-March. The number of tax returns received is only slightly lower this year than last year, as you can see here, down 1.7%. And the number of tax returns processed is also a tiny bit lower this year than last year, down 1.4%. But the average tax refund amount is up by 5.2% year over year to $3,271 this year. And it would be interesting to understand whether this increase just reflects inflation at work or whether there are deeper drivers. So at first glance, this looks like it's all roughly in the same range as last year, maybe with a single exception of the sharp drop-off in visits to the IRS.gov website, which are down by almost 45%. I'm not sure where this might come from, but if you have some thoughts on what might have caused this steep drop in IRS website visits, do leave a comment below and share with everyone. So from this table here, it seems that despite some initial worries, this year's filing season seems to be going ahead as usual so far. And for those of you who've asked, the Wall Street Journal says the IRS is answering the phones. There don't seem to be any undue delays if you expect to get some money back either. Refunds are going out. Some filers are seeing refunds hit their bank accounts in less than a week after they file, tax professionals said. And perhaps it's not so surprising that the IRS appears to continue functioning along the lines of how it did in the past. For starters, the administration mostly delayed taxpayer service cuts to avoid damaging tax filing season. So the most immediate changes are being felt in enforcement, meaning in tax auditing, but not in immediate customer service. That said, this business as usual at the IRS may also be due to a more fundamental reason. Even with the IRS staffing cuts that have been implemented so far, IRS staffing levels are not completely out of the historical norm. At the end of the first Trump administration in 2020, the IRS employed about 76,000 full-time equivalents, or FTEs as this measure is called in short. So in this counting, 2 employees working half-time each would count as 1 full-time worker, which probably gives us as realistic an assessment of the workforce capacity in the IRS as possible. And it appears that when the Biden administration took over from the first Trump administration, they did not think the staffing level of 76,000 FTEs was enough. From Politico back in 2021, Biden proposes doubling IRS workforce as part of plan to snag tax cheats. And that hiring initiative does appear to have been at least somewhat successful. At the end of 2023, the IRS staffing had increased to almost 83,000 FTEs. 2023 is the last year that the IRS has published official numbers for so far, but the IRS staffing estimates for 2024 range between 90,000 and 100,000, depending on which news outlet you read. At this point, and in its efforts to make the government more efficient and reduce spending, the second Trump administration is trying to get the staffing back down again. It froze all new hiring, and according to the New York Times, the IRS has already laid off more than 7,000 people, mostly those who had recently joined the agency. We couldn't find an official final target for the planned cuts at the IRS, but from Reuters, IRS staffing cuts may total 25,000 workers in the near future. This doesn't sound completely implausible, because if we go with the starting assumption of a workforce of about 100,000 employees, cutting 25,000 workers would get the IRS staffing to around 75,000, roughly back where it was at the end of the first Trump administration. Now, those are clearly all difficult discussions and decisions, and never much fun for anyone directly affected by job cuts. But from an overall perspective for our country, it will be important to balance out the necessary and desired efficiency in the government with the need not to hollow out the IRS and to continue to collect the taxes that are due as completely as possible. I guess we'll see the results with time. Personally, we don't plan on missing our tax deadline this year. In fact, we're not doing anything differently, and for those of you who may be considering testing your luck with the IRS, I leave you with this Wall Street Journal quote from the head of the Tax Institute at H&R Block. Don't get yourself in trouble. The rules still apply. So, what do you think? Will fewer people file their taxes this year and drive tax revenues lower? Drop a comment below and let me and the community know. And let's move on now to the next section of today's video. Which treasuries rose the most and which ones fell this past week? The Federal Reserve's Preferred Inflation Gauge, PCE, the Personal Consumption Expenditures Price Index, was released on Friday. Core PCE, which excludes more volatile food and energy prices, rose 0.4% on a monthly basis. On an annual basis, core PCE was up 2.8%, slightly higher than the 2.7% from last month, and still well above the Fed's 2% target. So not great news on inflation, especially with the next round of potential tariffs just around the corner. Now, as we so often do at the end of the week, let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. So the final picture for Treasuries didn't change that much at the end of the week, despite some volatility in between, especially on Monday. Treasury yields across maturities on the short end and the long end ended a few basis points higher than the previous week, with the 20-year and 30-year up the most at 5 basis points. The 3-month, 6-month, and 1-year were literally unchanged. And everything in the middle, from the 2-year to the 7-year, was down slightly, with the 2-year down the most at 5 basis points. The 2-year, 3-year, and 5-year are all now below 4%. Driven primarily by rising inflation concerns, falling consumer sentiment, and a slowdown in consumer spending. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black, and decreases in rates are shown in red. The 6-month remains the only maturity that is still slightly higher than where it started the year, as it continues to cling to its tiny 1 basis point increase, the same as last week. All the other maturities are down since the beginning of 2025, with the most significant downward moves to be seen on the 2 through 10-year maturities. The yield curve has gotten a little bit steeper though, with the 1 month and 30-year showing a positive difference of 26 basis points this week versus 23 basis points last week. And the more widely used comparison of the 2-year and the 10-year is showing a positive difference of 38 basis points this week versus 31 basis points last week, meaning that despite this week's economic data, bond investors seem to be a bit more optimistic this week than they were last week about the direction the economy is headed and the possibility of a recession. Things can change pretty rapidly from week to week and even from day to day in the current environment. So as always, stay tuned. We'll keep our Diamond NestEgg regulars posted with relevant updates. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What's on the upcoming Treasury auction schedule? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. There's also a 14-day CMB for those of you who like your spontaneous cash management bills. And because I know some of you do, this 14-day CMB is available for purchase from Fidelity and E-Trade at the moment. It's not available on Schwab or Vanguard, as they normally do not offer CMBs at auction on their platform. So other than that little bit of excitement, it's pretty quiet on the auction front this week. Now, for those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially. The highest yielding new issue agency bond on Fidelity's platform at the time of this taping is from Federal Home Loan Banks at 5.87%, with a first call date in April 2026. The QSIP is 3130B5QF8 for those of you who may be interested. For corporate bonds, the list is somewhat short this week. Based on what we've seen in recent months, this tends to happen during weeks of higher than expected market uncertainty, such as election week last year and whenever there are major potential tariff announcements or implementations planned. In any case, the highest yielding new issue corporate bond currently is from National Rural Utilities Cooperative Finance Corporation at 5.75%, with a first call date in April 2030. The QSIP is 63743LAM5 for those of you who may be interested. For brokered CDs, the highest yielding ones are from Morgan Stanley and Jonesboro State Bank at 4.5%. The Morgan Stanley ones have a first call date in October 2025, and the Jonesboro one has a first call date in July 2025. HEREIN, which refers to itself as your secure one-stop savings marketplace, is offering a $250 bonus when you deposit $25,000 or more with code GET250 at sign-up. This limited offer is for new customers only, and if you read through the fine print, the first deposit must be initiated between March 3rd, 2025 and March 31st, 2025 by 11:59 p.m. Eastern Time. Many thanks to our Diamond NestEgg fans who emailed us about this promotion. And as always, if you know of any bank CDs or checking and savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. Or send us an email for a more personal touch. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about treasuries and bond investing in general, then check out this video here on our bond courses. And come join our next live member Q&A on Saturday, April 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 2, 5, and 7-year T-note auctions and all things fixed income. And if you're interested in potentially getting a bit more yield out of your treasuries, this month's member video, which will be released very soon, may be one that you won't want to miss. I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.